as we look at businesses, for us, it is the qualitative piece has actually become arguably more important, and the quality of the team, the integrity of the team, the personality of the team and leadership, how well they've sort of brought next gen on and into the organization. The client experience is an incredible variable to me, just because that is really fundamentally where all of the alpha lives, all of the revenue lives, all the client satisfaction, all the referability, the stickiness, all really fundamentally lives in the client experience. Those softer sort of aspects of the business are really important. How well they market, how well they tell their story, right? How well do they understand who their client is and how well they talk to that market and their clients. Those are all things that we spend a lot of time wanting to understand before we make an investment.
This is the Business of Advice podcast, where we help good advisors become great business owners. Today's guest, Matt Brinker, is someone that I've gotten to know very well over the past few years and have recently actually partnered with here at Advisors Excel on several transactions that I'm sure we're going to touch on during our conversation. A little background, Matt is a managing partner at Merchant Investment Management, a strategic and capital partner to financial services companies that helps them grow and scale. But prior to joining Merchant, Matt was the Chief Business Development Officer and Head of Acquisitions for United Capital, which has been in the news a lot these weeks that we're recording, where they grew assets from over $300 million to $25 billion before selling the company to Goldman Sachs. Matt, buddy, it is good to see you. Welcome to the Business of Advice podcast.
Yeah, and it's awesome to be here, Cody. Appreciate you having me on.
This is you're going to bring so much unique perspective to the advisors that listen to this. I know there's going to be value that any entrepreneur can get from this, but this is going to be one of those that for our advisor friends that listen, just a lot of value in your background that I know you can add here. I touched on a portion of your background. We were actually talking before we started recording. You're a proud University of Colorado grad, excited about Dion being back there, but maybe just tell everyone a little bit about your journey, and then maybe out of that, talk a little bit about your role now at Merchant and what you're doing there.
Yeah, sure. So I literally grew up in the wealth management space. My dad had the consummate lifestyle wealth management firm in Denver, Colorado, where I grew up. So I've been in this industry since I was 5. So I've really sort of enjoyed and learned a lot from my dad, my late dad. Just how when this industry is applied right, how impactful you can be on people's lives that go far beyond just their financial well-being. So I've always had an incredible amount of respect for this business. When we sold United Capital in 2019 to Goldman Sachs, it was I had really no interest in working at Goldman Sachs until I left when the deal closed, and I had a year off for the forced year off to sort of think about and contemplate how I wanted to spend sort of the second or third whatever phase of my career. And, I certainly wanted to stay in wealth management. And I really wanted to take a lot of the learnings of what we did right into the next phase, but also learning a lot about what we did wrong at United Capital. And I sort of apply that to my next endeavor. And I happened to get synced up with a bunch of really like-minded individuals at Merchant, my current partners, that had also done really interesting things in wealth management. I always like to let people know is that we're operators who happen to invest in wealth management.
Yeah,
and it's an important distinguishing characteristic about our team, and I'm incredibly proud of that. We've all built wealth management firms. We built United Capital from scratch to Jim Bello, started Dynasty, and so he has his perspectives on the world. David Mrazek was at Focus Financial. Mark Stoker and Scott Prince came from, of all places, Goldman Sachs, so they have that big bank institutional perspective, which is incredibly helpful and healthy. And Rick came from Merrill Lynch, and Brian came from the independent broker dealer space. So, I think like a lot of us, I grew up doing team sports, and really appreciate, as right, with your partner David, what it's like building something with a team versus sort of doing it solo. And I think one of my biggest strengths is humility and understanding where your blind spots are, and making sure that you put the right people around you to cover those blind spots, because I have a lot of them, and I count on my partners helping me out with those blind spots for sure.
Yeah, that's a good thing to realize. We all have those, so it's good to have those people there. I mentioned this earlier. We kind of met Merchant through you. Actually, we were talking to you a little just as you had exited United. What we were seeing going on in this space is so many advisors. There's a lot of acquisition going on in the space. A lot of these roll-ups. A lot of our advisors were asking us questions. So I think Dave and I set out to meet people that we could learn from. Very much what you just said there, not something that we had a lot of working knowledge in. And then you introduced us to Merchant when you joined them. We've now partnered together, and I want to talk a little bit about that. I think part of our partnership is we had advisors. A lot of them, I think, were looking to sell maybe a portion of their practice. Maybe they either wanted some capital to fund additional growth, or I think some of them, as you've met, just maybe wanted to take some chips off the table. But what I would say is, prior to our partnership and being able to help them with that, a lot of the options were only to sell 100% of their practice. A lot of this acquisition strategy right now is like, you got to sell it all and you're going to work for someone else. You've stepped in. You guys have made some investments with us into some of the firms, which has been really cool to watch. But maybe I'll start here. What is it about financial services in this space that has been so attractive to Merchant?
Yeah. So I think there's two answers. One is, which isn't the best answer, which is all we know.
Yeah.
Right. Like,
it's a good answer.
We really, yeah, I mean, it is. It's like we really understand. We understand what it's like to sit in front of clients. Right. Like we understand what it's like to deal with integrating technology. Right. We understand what it's like to manage next generation and figuring out organic growth, and so. We tend to really, we know the space really well, and then there's sort of the business school case study components of financial services, recurring revenue for the most part, no inventory, massive macro wave of $65 trillion transitioning from boomers out to the next generation, women controlling, some $30 trillion of wealth, and this migration to independence, and the benefit of integrating and operating on an independent platform, the rate at which technology is making it easier and more efficient to hit above your weight class a little bit. So, you kind of look at that whole picture. For us, it just is, it's just an obvious. It's an obvious investment thesis for us that just we're thrilled to be a part of.
It's funny. I don't know that I've ever articulated this, but I've had people ask, Dave and I, as we've done some of these investments with you, they're like, why would you be investing these? And I always say, because I know the business well. Like, my most successful investments tend to be in the things that I know really, really well, not in things that I don't know well. And all the macro reasons that you listed too. I'll ask maybe a follow-up question, because what I want advisors, and I think one of the things even in our partnership, I know you're going to be speaking at some of our events too, is like, we want, one of the things we talk about all the time is our mission is to help good advisors become great business owners. And we say, so they can help people have an amazing retirement. But part of being a great business owner is understanding how to build real equity value in your business. And that's the thing that I think some of our advisors' eyes have been open to, is like how to do that. So I want to spend some time talking about that. But when you look at
Sure.
an advisor practice that you're going to make an acquisition in, what are you looking for as far as like the structure of how the firm's set up, the leadership, the numbers? What are some of the things that are like the first things that you're and I'll say you, but Merchant is going to look at when they look to make an investment?
Yeah, so I think it's fair to sort of kind of break those out into two key pillars, and there's the qualitative and the quantitative piece. And the quantitative piece in evaluating these businesses from a revenue mix perspective, from operating margins and organic growth history are really obvious and easy to understand.
Yep.
Right. They're really, my sophomore in high school could probably unpack a P&L pretty quickly. Like, yeah, this is like a pretty good business.
Yeah.
So that part is relatively simple to kind of get to, and the market's done a pretty good job of framing valuation and ranges in which these businesses are valued, and that spectrum starts to that EBITDA multiple tends to sort of trend up as businesses become what I could sort of consider enterprise businesses, right? Businesses that start having real enterprise value.
Yep.
And so I as we look at businesses, for us, it is the qualitative piece has actually become arguably more important, and the quality of the team, the integrity of the team, the personality of the team and leadership, how well they've sort of brought next gen on and into the organization. The client experience is an incredible variable to me, just because that is really fundamentally where all of the alpha lives, all of the revenue lives, all the client satisfaction, all the referability, the stickiness, all really fundamentally lives in the client experience. Those softer sort of aspects of the business are really important. How well they market, how well they tell their story, right? How well do they understand who their client is and how well they talk to that market and their clients. Those are all things that we spend a lot of time wanting to understand before we make an investment, and then the components around what's the partner going to be like, how are we going to be together as a partnership, right? Like, because I think most transactions go bump in the night post close because there's just been a miscommunication or a misunderstanding of expectations. What do you want from me? What do you expect? And what are we expecting you? Right. And so having that really sort of laid out and understood, and being a minority investor, it's really easy to do because we're not controlling the business. I think when it comes to those transactions that are full control takeouts, and I've lived it, where there's a lot of friction post close when there's just been a mismanagement of underlying expectations. How much of IM is supposed to be brought on platform? How much tech integration am I really supposed to have? How much control do I or don't I have in the client experience? How much can I spend on marketing and the like? So, long-winded answer to your question, and I hope I answered it, but hit the refresh button if you want me to go back and answer something.
No, that's good. And my follow-up was going to be, and you kind of set it up. Could you talk a little bit to, here's how I want to phrase this, I guess, is you've come in, you've now partnered with someone. Like you said, a lot of the transactions you're making, or specifically that we're making together, have been minority, to where the advisor's still the majority owner, still in control. But that doesn't mean that their life doesn't change a little because they now have a partner in the business with them,
Yeah.
and there's certain responsibilities. But I was going to ask you to talk about a couple things here. One, you have this independent entrepreneur business owner who now has a partner. Like, what are just some things they should be thinking about and expect going into a relationship like that? And then second, could you talk about maybe how that's even how that might look different if it's a minority versus a majority? I think you've heard me tell this story, but we had an advisor who sold their entire company to a firm that you would know. I won't mention the firm, and they fired him after a year. So he no longer works for the firm that he started because he didn't, they butted heads, didn't see eye to eye on stuff. And, he was pretty frustrated, but told him like, hey, it's not your company anymore, right? You sold the company, you work for them now. So maybe just walk through like, what are things that they should be thinking about that may be new or different than what they're used to? A lot of times what I've seen is maybe it's the accountability around financials and some of that, but then also just majority versus minority.
Yeah, it's pretty stark, right? And I bought 90 plus companies when I was at United Capital. We were a full control owner.
Yeah,
and so they went from employees we went from entrepreneurs, business owners, running the show, calling the shots, what the shade of magenta on the pie chart, right, to a W-2 employee.
Yeah.
And a lot of the folks that made that decision are a little bit throwing up the white flag a little bit, right? What I call white flag companies. And there's a rationale for people to sell 100% of their business, right? They're looking for full liquidity. They want to bolt onto a platform, and they want to get out of the operations of the business. They don't want to be in compliance, right? And there's a good segment of the industry that's really appropriate for.
Yep.
And going into those transactions, eyes wide open, you said it, Cody, you're an employee. You've sold the business, right? So everything that the mothership is cooking, you're eating. That's just how it goes.
Yep.
Full stop. And, there's optics of control, input, and everything else, but it's optics. And again, for a segment of the advisor space, that will continue to be a great solution. As I think about the minority investors, us being a minority type investor, and there's other folks that are doing it, we've taken just a completely different approach and philosophy to this idea of providing growth capital to the industry. And we're finding that there's a much wider, much greater swath of the industry that is wanting to maintain control. They want to have complete autonomy in terms of the business decisions that they're making for the next 3, 5, 7, 10, 15 years, however long they think about wanting to continue to grow, control the business. That being said, you do have a new partner, as a minority investor, and there are certain things that come with that, right? There are certain protections that we have as a minority investor that we think are incredibly fair, but they are, we're going to have some insights into, control mechanisms around the financials. We are going to have some input around, the ability to take on debt or dilute shareholders. Everything that you would expect from a minority investor in your business, and standard protections that we would like to have. What we prefer about the dynamic is the alignment that we have, right? So we're investing in a business, we're providing capital, like you said. Some of it is for growth capital, some of it's for liquidating some of the leadership, but we understand going into it what is the intention of the capital, and we also understand what are the underlying, the underlying value that we think that we can bring to the partnership. And that goes back to the diatribe on being an operator.
Yeah.
And right, so some of our firms are, what I sort of consider emerging enterprise firms, or are enterprise firms looking to accelerate their growth. And on the enterprise side, those firms tend to be, 3-5+ billion of AUM. They've sort of figured out a consistent client experience. They've got executive leadership. They've got operational expertise. They've figured out marketing and branding beyond just referrals, so they know where their next client is coming from. It's a lot of the lifestyle nature of the business has sort of been extracted out of it. And so the emerging firms, emerging enterprise firms, we're spending a lot more time with them, helping them sort of get to that next stage of enterprise where, like I said, those components aren't yet fully developed. Some of them are developed. And so we spend a lot of time with those firms, helping them sort of figure out, and a lot of what our partner firms do as well is, in terms of use of proceeds, is using our money to finance acquisitions.
Yep.
We get very excited about it. We provide a deal team to our partners to help them sort of, think about
growing and scaling
evaluating
that
the
way.
business.
Yeah.
Yeah, man. Yeah. So
let me ask this question, because I know this is this is the conversation that comes up the most. So I maybe you can talk. It doesn't have to be super specific, but what are general kind of guidelines around valuations today, right? Talking to advisors, you hear all these different ways that firms are valued, but maybe just in your mind, I know, I guess I would say even maybe we've seen valuations cool a little bit in the last 12 months, right? Some people that were doing acquisition have kind of pulled back a little with rates going up and some uncertainty. But generally speaking, how would you tell advisors to think about kind of benchmarks around the valuation of their firm?
Sure. So on a full takeout, right, going to an employee model, and you're right, the valuations have ticked down, quite a bit, right? Because the highly levered PE firms just are slowing down, because I think they're some of them are pretty digged up. But those firms are paying, in the 10 range. It's really hard. I'm happy to give the ranges, but it's very difficult to do so. There's nothing worse than being, dodging that question, because it's unfair. But I will caveat it in that, the variables at which, you're seeing these sort of outsized multiples, a lot of those firms are high growers. But I also would say what the industry does a horrible job of doing is detailing price and terms. You're right. The old adage, right? I'll name the price, or you name the price. I get to name the term.
Yep.
So we see these headline numbers.
Really good.
We don't really get to see, what does the 2-year earnout look like, and how aggressive does EBITDA growth need to be, and do you have to cut 50% of your head count, and so. And I've lived that world, right? Like, we raised capital in 3 different tranches where we negotiated the deal with Goldman Sachs, right? Like, there were a headline number, and then we had to, but they had to deliver additional growth to it to hit sort of the headline numbers. So I'd be very cautious of the headline multiples that we're seeing out there. In the minority world, again, variables aside, that's going to be, 6 to 8 times, and sometimes higher if the firm is bigger and growing. That's how I'd answer that question.
Yeah, and I would say a few things there, and this is what I try and tell advisors, right? Growth rate. Here's the things I've seen, even I think working with you all and understanding a little bit more. Growth rate is a big part of it. I think maybe one of the things that has excited you all about the advisors we brought to the table is like they have a really strong growth rate that's been consistent over years. But Also, it's that mix of business. Obviously, we have advisors who do a little more insurance, which tends to be a little more upfront. But making sure that there's a healthy percentage of that revenue that is recurring is a big factor there. And then the other thing I think sometimes they don't realize, and this is, I think, where we're creating some opportunities for some of these partner firms to go do acquisition, is it also has to be worth people's time, right? Like, so you guys have a limit, you have a large pool of money to work with, but you have a limited amount of time and resources. So if they're not at least at even a certain EBITDA number, like their pool of potential buyers, shrinks dramatically also, because sometimes for, firms that are well capitalized, like they've got to write a check that's significant enough to be worth their time also.
Fair. Yeah, fair. And for those smaller firms as well, I mean, it's important to understand that the value of your business is inversely correlated to your importance to the business.
Mm. Yep.
Right. And
Yep.
so I think, it's hard to write checks to those businesses when, the actual value goes up and down the elevators every day in and out of the office.
Yep.
You know what I mean? So that's why we spend some time with firms helping them sort of think through and evolving from that lifestyle into that emerging enterprise. And, because you're not going to sit at 70%, margins and also have enterprise value.
Yeah.
Right. So that, and I'm seeing a lot of firms make those conversions.
Yeah.
Right. Like dropping their revenues and dropping their profitability, reinvesting in the business, adding additional talent, because again, it's lifestyle businesses just aren't really worth all that much.
Well, I said in the beginning,
more to you than they are a buyer.
Yep. I said, our goal is to help good advisors become great business owners. And we say all the time, like, you're not a great business owner if the business dies with you, right? Like if it can't survive without you being in the business, that's you can be a really good advisor. You're just not really a great business owner. And I think that's obviously the thing we see too is, right, you've got to be able to build that enterprise value to increase the equity value. Doesn't mean you can't create, and this is something I want every advisor, heck, any entrepreneur to hear. It doesn't mean you can't create a business that is wildly successful and produces an incredible quality of life and income for you. It's just like to build that equity, value for the business. There's got to be an enterprise there too. So you mentioned you mentioned private equity, and obviously we've seen a lot of it come into the space. Generally speaking, I think it's provided some great liquidity options for people that want to sell. But do you see any red flags there? Like, as you've been in this space, you've been involved in private equity backed roll ups. Like, what are some of the downsides to it, or is there anything that you're seeing that is kind of this counter view to what's going on in the space right now?
Yeah, well, I mean, I think last year private equity represented 60% of every transaction that was done. So, it's that capital is prevalent, and again, it's really hard. It's really hard to generalize, and I think private equity gets a bad rap. There are several firms that have made really good investments, and they've sort of turned their positions into the knock on private equity is that the 3 to 5 year shot clock, right? Don't smash a bunch of stuff together, arbitrage it, flip it, leverage it up, flip it, and sell it. I think there's a handful of private equity firms that have figured out that they love this industry, they love the firms that they've invested in, and they're able to, make it up. This wealth management firms in Fund A, Fund B can buy the position from Fund A, and so they can have a little bit more longer run with it. So that kind of dispels this notion that private equity is just a 3 to 5 year shot clock it out. Now, there's been some. You mentioned it, right? This guy got fired. Your former, right? And now Allworth's 2 founders were bumped up to the chairman position, and Sage Spring and Newport Beach, their founder and CEO has been bumped up to, chairman and whatnot. So, I think the playbook that United Capital wrote and how effectively we ran that playbook, right? We ran that playbook, right? We used private equity money, grew it, grew it from 0 to 27 billion, had a massively successful optically exit. And that playbook has been repeated now, 5, 6, 7, 20 times.
Yeah.
And man, so kind of being on the back end of that, innovation curve is kind of a tricky spot to be in, where, it becomes an also ran strategy. And you're seeing some of these firms that are private equity backed struggle. Whether it's just the amount of debt that they have on the balance sheet, where valuations are, an inability to buy, an inability to grow the business post acquisition. So, I look, and CI is a very public example in that, the money that they raised. And the RIA Brooke did a really good job unpacking, because they're publicly traded.
Yep.
You go read that article by RIA Biz. When I was talking about price and term, if that was a privately held company, it would have been CI raises $1 billion, right? But because they're publicly traded, Brooke did a great job of sort of unpacking what came with that $1 billion and the terms of that $1 billion, and it is an absolute albatross of terms in terms of what they're going to need to do to keep that bad boy afloat.
This is completely off topic, but I think for any advisors, especially if you're thinking, acquisition and or some sort of transaction, RIA Biz is a great website. They should be following that. I mean, they just do an incredible job, really talking about the business side of the industry that if you're not following that, you should. You talked about your time at United Capital a little, and obviously, as we're recording this, it was sold to Goldman Sachs. Goldman Sachs just unloaded it to Creative Planning, 3 or 4 years after I think they bought it for a bunch of money. I only bring that up because this is one of those things I say. So I talk about the advisor who, was let go from his firm. How important is finding a partner that is aligned, that, here's other things I've seen, like sometimes staff gets let go, maybe the client experience changes dramatically, or even how the clients are invested changes dramatically. Just any like words of wisdom or things that you've seen on making sure that your partner is aligned, especially if you're going to continue to work in the business for a while?
Oh, man. Yeah. Yeah. We had when we were post LOI and working through the deal docs with all of our future partners, people that were selling their firms to us, I built an expectations document. And this was just learning, right? Like the first 5 deals that you do, you learn a lot. 5 through 10, 10 through 20, right? You just don't, if you're not sort of learning and evolving and figuring out your mistakes, then heaven help you. But, eventually we integrated this document that just was like, here's our mutual expectations of each other.
Yep.
Right. Like we're gonna treat each other with respect and dignity. We're gonna be open and fair about what we're doing right and wrong. But here are our expectations. You are going to integrate onto our instance of Salesforce.
Yep.
We, within being, conscious of tax and tax sensitivity to the client, we have a, 2-year program in which we will migrate onto our investment management platform. And so this was just a document that just sort of level set expectations. And so if you're selling 100% of your business to a firm, I would make sure that I understood explicitly what they expect of me and my staff as employees, because you are an employee. You will be told what to do, and how to do it and how high and when, right? As glorious as the sales process is and how fantastic that big check might sound, there will be, because that's the only way that these roll-ups can be valued and valuable. When I used to tell people that when you lifted the strings of United Capital, everything moves with it.
Yeah.
Right. It was a very, that's why Goldman paid what they paid for. It's a very portable business. Now, what creative planning is like is not a portable business. And then we'll see what happens there. But, and that's why it won't be as valuable as what Goldman paid for.
Yeah. It's you kind of said this, and maybe it's the expectations. The question I was going to ask is, like, in your experience, are there things that advisors aren't prepared for? Were there some things you saw most commonly that ended up becoming friction points? Like, if they're going to do a transaction, like, what should they be like thinking about as they go into that? And maybe hit that with expectations, but just any other things that you saw being like common friction points that advisors maybe just hadn't thought of.
There's a disconnect between being an entrepreneur, being independent, and being accustomed to putting the client's objectives first. And I think what people, I think what entrepreneurs and independent advisors really appreciate about independence is just the optionality that comes with the open architecture nature. Most of these buyers are operating boxes, and things need to live in that box. And so the client experience now lives in a box. And so I think most of the friction would really come from an advisor wanting something for his client that couldn't be done in the new box. And that became wildly frustrating.
That makes sense.
And bureaucracy, right? The speed at which things got done in your old firm, right? Versus how things are now done in a bureaucratic. And, bureaucracies have a function, and they have a negative connotation, but they're not bad, but they are a thing. And typically bureaucracies move slower than, other structures. So speed becomes an issue. And, compliance, right, now becomes a new order.
Yep.
Yeah. Look, I don't mean to make it sound like, a goulash, right? There's some great things about selling your business to a roll-up firm.
Yeah.
Right. You're not heading a client, right? There are investment management platforms and solutions that might be more robust than what you were able to provide. The amount of money that we spent on technology and making it easier for staff to run a business, to operate a firm was powerful. One thing I was really proud of that we did, and so I think these firms do pretty well, is career development for the support staff.
Yeah.
When you have a standalone business, you've got 3 people, and they do compliance, they do trading, they do fee billing, and the like. They're only valuable to your organization because they're acutely trained for your organization.
Mm-hmm.
It's hard for them to go and have other opportunities outside of your organization. There's not a lot of career trajectory and growth. And so in a bigger organization, we were able to create specific roles and responsibilities that gave people career progression, new skills, and development. Probably one of the better things that we did for the people that worked for United Capital.
Well, and you said, it's not all bad. The other thing is you do get a check. So, I mean, there is that component of it too, right?
Yeah,
so
it's, for sure.
But to bureaucracy, I'm not going to mention names, but one of our advisors who sold to one of these roll-ups, he said, this was a few months ago, we were talking, and hammering him, just kept, they wanted this budget put together, and he said he was just going to continue to ignore them. And I'm like, eventually that's not going to work. Like you are going to have to do the budget. And last time I saw him, he's like, yeah, I had to do the budget, So it is just a little different, like you said, but there's some positive too. And especially if you want to make that, but sure. I also think this is what I try and tell advisors. Like, I had a conversation literally yesterday with an advisor, and I told him, your business is never going to be worth less than it is today. Especially, so many of the advisors we work with, they know how to do new client acquisition. They know how to bring new clients in the door. And I'm like, you've mastered that. The advisor I was talking to, I'm like, no matter what happens, your business is never going to be less valuable. The assets, he's gathering $200 million a year in new assets into the firm, right? I'm like, the great thing is you have built this business that has incredible value, and it's just going to continue to grow. So like, you have all kinds of flexibility and time to figure out how to do exactly what you want to do. And I feel like right now, maybe some advisors feel like this is a once in a lifetime opportunity. And I keep trying to tell them, like, we're on the front end of what's going to happen over the next 10, 15 years in this space. I think everyone sees this as an incredible industry to be investing in over the next decade. So,
look, we started, there was a few other firms before us. But we were really the first firm, us focused, were the first firm in 2005, 6, that were investing heavily. That was, that's a long time ago now.
Yeah.
Right? And
yeah.
So I still feel like we're in the second inning of, because it just say that, this is sort of the top of the market would suggest that, the independent space is done growing.
Yeah.
And, you kind of look back into the early, 1900s, there's like 2,000 car manufacturers, right? It took up until, the 80s, right? 80, 90 years for there to be 3. I'm not saying there's going to be 3 large national RIAs.
Yeah.
But it takes decades for industries to consolidate, and it feels like we're in the the 1900s of wealth management relative to the auto industry in the United States.
Yeah, that's a great way. I just, that's the perspective I want all advisors, especially if they see like they want to do this for another 10, 15 years. Like selling 100% of your business today would be crazy at the rate so many of these are growing at. So,
you touched on it, Cody. That's the most important. That's 100% right. And you went back and looked at the 90 businesses that we bought, and you went back and looked at the average 3-year growth prior to selling to us, flat. Right.
Huh.
So that's what I mean. There's a swath of the industry that is perfect for a full exit. And
yep.
For the firms that just haven't figured out the next stage, the next how to level up.
That's good.
Yeah. So I think, and it's a simple math equation too, right? Just take the length in which you want to work, 10 years.
Yeah.
Put the growth rate on it. What does that eval look like in 10 years?
Yeah.
Versus what they're going to pay you today for the business, and everything that comes with selling the business. And usually it doesn't pencil.
Let me ask you one final question, then I want to jump into these lightning round questions, because this is the thing that I feel like I've dealt with maybe the most with some of our advisors who have sold, especially those who were maybe transitioning out. How hard, I say all the time, like significance is a basic human need or contribution. And I think when it comes to actually signing, so many of them, they've focused on the financial aspect of it, but then the emotional aspect of it kicks in. Like, man, this has been the last 30 years of my life. This is how I've gotten my significance. This is how I've made a contribution to the world. What did you see there? And just any advice for advisors as they like emotionally process that also?
Yeah, well, we called it the crossing of the bridge, and it happened every time, and it was a freak out call.
Yeah,
close. That was like at 10 o'clock at night, after a bourbon or two, and yeah. I mean, it was a very real thing, a real psychological sort of
Yeah.
soft side of how I spent my time with these folks is, they were selling their life's work.
Mm-hmm.
And that's, I think, again, you touched on it. The purpose is a tricky thing, and I think it's true for anybody retiring or selling their business to
Yeah.
sort of face that, regardless if you're, um, you know, stepping back and handing it off to the next generation. A lot of people struggle. A lot of men struggle with that,
Yeah.
figuring out, their purpose. But the Full Sail sort of is that very blunt,
Mm-hmm.
immediate sort of realization of that, um, uh, pretty significantly.
Well, and to tie this back into where you started, and you didn't say it exactly this way, but more or less said, you got a witness with your dad. Just I say all the time how noble of a profession that financial services can be, and the impact
Oh,
that you get to have. And it's one of the things, like tying it back into what we were just talking about. It's the thing that so many of our advisors get to help people do, right? Even for the person that's coming in making. I try and tell our team this here all the time. Like when people make that decision to step away from this job that has not only been kind of their financial security blanket, but emotional also, that's a big thing. And our advisors get to help them navigate that and find purpose and make sure that they're going to be okay. And so done well, I just think it's an incredibly noble profession that impacts a lot of people because you are helping them through some really, really big life decisions.
spot on. And we kind of, in Merchant, we take a very similar posture, right? Like um, we are a strategic investor in wealth management,
Mm.
and we're not designed. We're not three people in Midtown Manhattan with a spreadsheet and a checkbook.
Yep.
We're a 30 plus deep organization of people who are predisposed to engage with our partners to help them sort of think through and execute and plan on their strategic journey. Like it's just how we're built, and you talk about, purpose, that's our purpose. And, I also like to brag that our intellectual capital that sits within the four walls of Merchant pales in comparison to our network of people who
Yeah.
we've got like you all, right? Like we've got long-standing relationships with people love and trust to help us execute and help our partner firms grow and thrive.
Yep.
And bringing those resources to bear is for me. I'm just having so much more fun doing it this way. I'm just having a total blast.
Yeah, so you guys have been great partners for us and some of the advisors that we partnered with, and just like you said, an incredible team. Okay, let me hit you with some of these lightning round questions. These are they can be quick answers, just things I love to ask at the end of the podcast. But here's the first one, and it's be interesting for you because you were kind of making a big life transition when COVID happened. And what I've asked people is like, since the onset of COVID, I think everyone in a leadership role is like maybe learned lessons, but is there one lesson that you learned over the past few years that you think you'll carry forward for the rest of your life?
Authenticity, man. Like it is it just reverts as I get older, and it just reverts back to being authentic in your true self. It's just such a comfortable spot to be in, and your reputation is everything. It's just right. It's everything.
That's good.
The reputation, man. It's everything.
That's great. Okay, second question. If you can look back on your career, what's the one thing that helped you graduate from being good to great in your profession?
I think it was flipping from being obsessed with my own career trajectory and obsessing on the people around me's career trajectory.
Mm.
And it elevated them, which in part elevated me 10x what I would have done if I was just sort of self-obsessed on my own sort of, personal objectives and goals.
Really cool answer. Okay, third question. When you look at your own personal growth, is there something you're doing this year to drive your own personal growth that you're excited about?
Yeah, I think I'm a lot more um, reflective, and uh, and I think it's, when you go through a 15-year journey, and you end up uh, selling a business, and having some financial success. I think it's taking a step back, and really focusing on it, and gratitude of the people around you, um, and even though there might be some friction and some uh, some battle wounds and the like, but just really kind of trying to be really optimistic, and really grateful.
That's good.
Is critical. Yeah.
Okay. Okay, this may be interesting, especially with your background in financial services, but what is the one book that you've recommended most to other, I'm just going to say, entrepreneurs or leaders?
Easy. The Innovator's Dilemma.
Good one.
I think for entrepreneurs that are challenging and willing to challenge the status quo, and continually think about innovation, and how to apply technology, and being mindful of either competitors, and being mindful of what their customers actually want, because someone's going to out innovate us, right? Someone's going to out innovate us. Even the biggest incumbents, get their tails whipped, and it's probably because they're not, thinking about how to continue that innovation curve.
This is a good one. Okay, final question. What is the best piece of advice that you've ever received?
It was probably from my grandfather, who was a executive from Ford Motor, and guy like sort of, really looked up to, just in terms of his career, what he did, traveled all over the world. Um, when I graduated college, he said, "You realize you're going to be totally worthless to anybody for the next 5 years. So why don't you go do something interesting?" And so I ended up moving to a ski town, and lived there for 5 years, and raced mountain bikes, and did a bunch of alpine climbing, a bunch of triathlons, and yeah, something that I have yet to regret taking the time to do. So that was killer advice.
Didn't set you back too much, so that's good advice. So Matt, yeah, I appreciate appreciate the time and the insights today. For those who maybe want to keep in touch or follow along with you, Merchant, what's the best way for them to do that?
Yeah, I mean, look, I super responsive to email. So Matt, merchantim.com. Grab me there. Website, merchantim.com, and track me down.
Yeah,
I'm available.
I appreciate it. It's always great to have you with us. For everyone who listens, remember I say this all the time, but we need great leaders more than ever today. So please go be great. Share this episode with any of your advisor friends who you think will find value in it. And Matt, as always, appreciate the time.
Oh, yeah, man. Appreciate you having me on, Cody.